Hello, today is Friday, the 7th of March, 2008. This is Brian Shannon from AlphaTrends.net. The market's closed, and we finished with a loss once again. The S&P 500 finished with a loss of 1.1% here today. And you can see that we've got this market below all the moving averages. All the moving averages are declining. And furthermore, the short-term moving average, you see the 10-day moving average, has just crossed back down again through the 20-day moving average. And clearly the trend remains lower. There's nothing on this chart that is remotely bullish. The market has still not, the S&P 500 that is, has still not come down to test the lows from January. But as we've seen from the VWAP tool, volume weighted average price, let me just throw another 5 days on there so we can get those January lows in. When we drag that line straight across, it gives us the average price the market is closed at, or rather traded at, since I started that line. And you can draw that from any point. For instance, on this day, the average price was up here at about 137. But since the January lows, the average price in the S&P 500 has been about 134 and a quarter. And you can see that earlier in the week we had seen that the market broke that 132 level that we had been monitoring. I had warned that these breakdowns usually don't lead to an immediate sell-off, that it would be nice to see a rally up to the declining 5-day moving average, which we did get, and I thought that might be a good place to put some shorts back out. The market found resistance near that VWAP and the which was also a location of the declining 5-day moving average. And you can see now that the S&P 500 for the week is down 3.1% as it just continued to make this nice series of lower highs and lower lows. There's that 5-day moving average when we look at the 10-minute time frame. Yesterday we broke that, again, that 132 level. That's where we have the 5-day moving average, which is declining still. So continue to say that there's no reason to look for buying opportunities except for very short-term trades. This morning, I had gotten involved on the long side in here on that on this more meaningful pullback to the VWAP, and then I had chosen to sit out most of the day. But you can see the market tried to recover here, and late in the day, once again, the sellers were making themselves present. So we still have, even on this 10-minute time frame, a clear pattern of lower highs and lower lows. So there's no signs of a bottom in here. There are no value stocks right now. When everything's going down, it just, it doesn't become more valuable. It becomes less valuable. So, value is constantly renegotiated based on perception of current events. And when you have things like AMBAC, which did their deal today, and they priced it at 675, and the people who got involved in that initial opening price, the people who have been shorting down the last couple days, I think, added some pressure to that. Don't read into this. Don't look at this and say, well, the market really treated that AMBAC secondary in a good manner, because it was largely, I think, a lot of the strength in there today, and you can see that it's just a broken stock. But the strength in here is probably largely due to short covering, and that's what I call more of a knee-jerk short squeeze versus capstone. This is more of a structural short squeeze where you have a nice uptrend, and these are the better short squeezes to go after, the ones with the nice uptrend. Let's take a look at that XLF. It did finish with a gain of 2 cents today, and definitively took out those lows from January today. And it did so on lighter volume, which is pretty typical. This is the big panic, and then on the test, we typically see there's less panic, less emotion. But again, there's still no sign of any bottom in here. I think that if you're a super aggressive, disciplined and experienced trader, maybe next week, clearing this level, and if we can get that 5-day moving average to flatten out, it gets above there, maybe we see a short squeeze rally in these financials. But still, clearly, very, very badly damaged group. No reason to be looking for a longer-term bottom. It's going to take a lot of time to heal the damage done in here. Real big volume sell-off this week, maybe capitulation. We'll see. You only know in hindsight, but and time will give us that objectivity to look back and say, here's what did happen. But for now, while the trend is still lower, the odds favor further downside, or at least consolidation through time. No reason to again look for the bottom. The Russell 2000, the IWM, finished with a loss of 21 cents. Looking like it's still kind of inevitably going to close in on these lows from January. Obviously very badly damaged. We saw that 68 level violated earlier in the week. The market rallied up a little bit and then sold off very nicely. Well, one thing you could do is take a look at what's called a measured move here. If we take the height of this, we call that A to B and this B to C. What we do is we take the height of this and project down towards about $63 a share, which would certainly bring about, I think, a little bit more panic in this IWM. The longer term, that is the weekly chart, is still obviously very badly damaged and remains in a downtrend. So, a downtrend is consisted of lower highs and lower lows. No reason to think it can't make another lower low. So continue to be very careful in there. This, again, the 68 level is what really, we'd seen the 68 level break, and then the market rallied back above that briefly. Came up to this declining 5-day moving average. That's where the sellers came back into it. Today we saw a pretty good volatility in here with a gap down, immediately recovered, but then came down and tested those lows again. So perhaps this is part of a bottoming process, but the only thing that you have is to indicate that maybe it's part of a bottoming process is that this level was tested and didn't go lower. But even even the shorter term moving average on the 10-minute time frame, they're all still declining. Nothing there to indicate any reason to get involved on the long side. Similar to what I was pointing out on the XLF is that maybe this level near 67 next week. If this 5-day moving average can come down, flatten out, this market makes a higher high, higher low, and then a higher high, breaks past there, perhaps we could get a little bit of a short squeeze rally. But again, we're going to now have this bigger 68 level as potential resistance. The bottom line is the market remains in a downtrend. It's guilty till proven innocent. Anytime I talk about potential long side trades, they're only meant for the most aggressive, most experienced and disciplined traders. Anyone else, cash is a position. Cash gives you the objectivity to stand on the sidelines, and you can say you're missing out on opportunity costs, but if you're not good enough to move quickly in this market, you're going to get your face taken off, and that's really what's been happening to the longs in here all year. The NASDAQ 100, again, I was kind of pointing to this descending triangle that might indicate a move down towards 38 bucks a share. The 30-minute time frame, I guess these are some levels I had left in from yesterday, but what we saw in here this week was this this lower ascending trend line had broken. The market rally, broke to a lower low here, but then rallied to that declining 5-day moving average again. It's still finding resistance along that declining 5-day moving average. When we look at the 10-minute time frame, you can see there we've got this 42.10 level. We've got all kinds of resistance up at 43.5. Of course, that 44.5 was a bigger number. The 5-day moving average is still declining. There is no indication here of a bottom. It's good to see the heavier volume and that the fact that the market did attempt to recover after, first it had that initial rally and then it sold off throughout the day and then it came back up right to the VWAP. But again, we're in a bear market. There will always be bounces in a primary downtrend, but those bounces are not to be trusted and they should only be traded by the most aggressive traders.